Hello and welcome to Inside Out, a show where we focus on individual stocks with in-depth analysis. We deep dive into financials and also tell you about the key risk and triggers going forward. Hey Sonal.
Hey Nigel, and not only that, right? We also will put spotlight on all the metrics that you just spoke about and also ask the questions that all the viewers want to ask. So let's not waste any time and get to our first stock today. What do we have on deep dive?
Well, Sonal, the monthly sales numbers had come out and they looked pretty strong, particularly for the CV segment itself. And Jamna Auto, well, that's a key beneficiary of the CV cycle. They are the largest leaf spring manufacturers in India, which basically deals with the suspension for commercial vehicles. The company is a key beneficiary of the higher fleet utilization levels, a pickup in replacement demand, and also on the government's thrust on infrastructure development ahead of the big general elections.
Okay, all right. So that is about Jamna Auto. But let's get in the management, right, to understand more about the company and the business as well. We are now joined by Mr. Randeep Singh Jauhar, who is the Chairman and Executive Director of Jamna Auto, to take up some questions as well. Mr. Singh, thank you so much for joining us and welcome to the show as well. Well, as Nigel was mentioning earlier, your company is a key beneficiary of the CV upcycle. So first up, is FY24 heading to be better than the last fiscal, which was FY19, the best last fiscal that you had, as there are tailwinds ahead of national election, and also scrappage testing could spur demand for you?
You know, I've stopped predicting the future because of the way the industry has performed in the past decade. So yeah, if all things go okay, we should have a better year than our peak, which was 19.
Well, sir, it wasn't visible in the recently declared numbers, but any impact of higher interest rates on CV sales in particular?
So, I mean, the CV demand all depends on the profitability of the CV operator. And interest rates obviously plays a very major part, but I think it all goes back to the demand. So if we see that the freight demand is going up, and we also see a pent-up demand, which means that there is a shortage of vehicles, he will get his pricing. So I think these factors play an equally important role. So very difficult to say that interest rate will play a major role in the demand. I think it should continue to rise, the CV market.
So, Mr. Singh, just to confirm, so basically high interest rates have not yet had any impact on demand is what you're saying?
Currently, not at all. I was talking about the future. I don't see going forward also.
All right, Mr. Singh, we'll just come back to you with more questions. But Nigel, we got the part that it's a play on the CV cycle or the upcycle. But tell us more about the company's products and its clientele as well.
Okay, let's address that. Well, its clientele includes all the top CV players. And as the map indicates, well, the company has its manufacturing units near most of the OEMs. And the strategic location makes it the market leader among OEMs. Well, the company's key products include conventional leaf spring. That's the largest part of its revenues. But other newer products like parabolic leaf spring, among others, is also gaining traction. This as they are strong but relatively lighter in weight, which can ensure better fuel efficiency. They've also been repeatedly focusing on increasing the content per vehicle.
Okay, all right. So that point is taken. Mr. Singh, back to you now. You're the leading manufacturer in leaf springs, as Nigel just mentioned. What is your market share in OEMs and replacement market as well? Much smaller competition is also showing some aggression. So that's the reason why I asked this question.
Okay, so to answer your question, I mean, there are a lot of competition. This leaf spring market is highly fragmented. We will continue to maintain and increase our market share in the OEM sector. 65% in OEM, 20 currently in the aftermarket. The total market should be about 5,000 crores, 50-50, both divided between OEM and aftermarket.
Okay, all right. We take your point talking about higher market share than the industry in some segments. But Nigel, let me come to you. What about their revenue mix between OEMs and aftermarket as well? And what are the targets that management has put out? What is their guidance in terms of growth? Well,
they've launched this product, Project Lakshya actually. That new product should be gradually increasing and should contribute around 50% of revenues. they've also been making progress over the past few years. Now, new products is defined as all products besides conventional leaf spring. They've also been focusing on ramping up the new market contribution, but that has some distance away before it goes towards that targeted 50%. New markets, by the way, that includes replacement markets and export markets as well. Well, Mr. Singh, let's come across to you and understand more about this project Lakshya. It indicates that you want to go to 50% of revenues from new products as well as new markets. Give us timelines for both these two targets.
Okay, so this is we did print this in our last year's annual report that by year 26 we should achieve both these targets of new markets and new products to hit 50%. And I think we are on track. I mean, considering COVID and whatever has happened in the past, we feel that we are on track to achieve these targets by year 26.
Okay, out of the total revenue contribution, how much can exports contribute? I understand for the last few years it's been minimal, but you have a target out there as well?
Okay, so exports, I mean, right now we're only about 1% of our sales. Our target is again by 26 to reach 10% of our sales as exports. Exports, there are various factors. I mean, as a company, our main focus is to have a return on capital employed of 50%. We want to be zero debt. We want to have a lean company with minimum working capital deployment. So if it fits into our strategy, we will obviously pursue exports. With China, exporting a lot of springs going a little, I mean, it's easier for India now because of the China situation. The opportunities of exports go up. However, considering inflation, considering the oil impact as a country, if we are competitive, and obviously the government's incentives and making a level playing field for us, exports, if it becomes competitive, for us to get business overseas should not be an issue. However, we have to keep the profitability and other factors in mind, which meets our overall strategy.
Okay, Mr. Singh, we take that point and you've given us a couple of details there. But Nigel, what we track other than understanding the business, of course, is the financials. So tell us, how has the company fared? What has the revenue growth been? And how have the past quarters looked like?
Okay, all right. Let's do that then. Let's turn our attention to the financials. FY19 was one of the best years for the CV cycle. It's perfectly reflected in its numbers with regard to the financial performance in that year, where they delivered 2,100 crores of revenues and margins as well at around 13%. Now, all eyes are on FY24. If they can replicate this sort of a performance is something that the street is looking forward to. Quarter-wise, well, in the past few quarters, they have been going at a run rate of around 550 to around 600 crore rupees per quarter. But margins, well, now they're barely holding in the double digits, as you can see. Well, Mr. Singh, I want to understand a couple of aspects. What's the margin difference between OEM sales and replacement sales?
Again, I'm going to give you a macro picture because there are many products and many customers and many models and everything. But on a broad macro level, it's anything ranging between 3 to 7% is the difference. So aftermarket is obviously a much better realization, contribution, profitability for us.
Okay, so Mr. Singh, you've also been talking about increasing content per vehicle. What is it right now and where do you see it being headed to?
There are many models. Our content per vehicle varies in various models. So I'll give you a figure of about 40 to 50,000 rupees per vehicle is what the leaf springs are. With adding new products, air suspension, now again it depends where the models where our new products are being used. If the share of business of that model goes up, our content per vehicle obviously will go up. So again, a macro figure, I think anything between 25 to 40% should be the increase in our content per vehicle going forward.
Well, we were just telling our viewers that they're going at a run rate of approximately 550 crores to around 600 crores per quarter. Give us a sense about the blended utilization levels. And at peak, what is the revenue potential per quarter from this 550, 600 crores?
Again, future predictions, very difficult. But we are right now running at a 60% capacity utilization. and which you are saying is about 550 crores. And again, when the demand goes up, there is a lot of balancing of equipment, because we don't know what kind of models will come, and are our lines balanced to produce that. So let's take a comfortable figure of 80% capacity utilization, which would take our sales to about 800 crores. So yeah, that would be again a very macro kind of an answer to, depending on various factors.
Okay, so 800 crores per quarter at peak utilization. That's the number that you've given us. But the worry is margins, right? It's stooped to low double digits now. So what is the margin band can the investors work with for the company going forward as well?
Let me kind of explain this, the margin. There is a little bit of confusion in this. Our margin per product remains the same, because whatever price increases we get in raw material, we pass it on to the customer. Now, because the price goes up, the margin goes down because of the percentage goes down, but as a figure per product, it remains the same. So our margins are not impacted. However, the percentage, because of higher sales, gets impacted. So to answer your question, I don't think we have issues of retaining margins per product, because we just pass on whatever increases come. And as far as oil and inflation and salaries, we have a very aggressive cost-cutting culture in our company. We always offset those increases by the efficiencies in our cost-cutting.
Mr. Singh, since I did not get a number, I'm going to ask you again, because we want to know what is the margin band that the street can expect, considering all the factors that you just spoke about.
So yeah, I mean, it'll be double digits, higher double digits. We will be in double digits. We won't be lower than that. Again, it's so difficult to predict going forward what the demand is, what the product mix is. But I mean, we'll obviously improve. It won't be worse off than the past.
Margins will improve from here on. That's our takeaway. What about revenue outlook for the next few years, given the pickup in the CV cycle, as well as the revenue mix focus? What's that likely to be?
Luckily, the CV industry is kind of linked to the GDP of the country. So if the GDP grows at, let's say 6% or 7%, we will grow more than that. The CV industry will grow more than that. And our company, because of content per vehicle, because of increase in market share, because of our focus in aftermarket, will be more than the CV growth. That's the best prediction I can make for the future.
GDP will grow, CV cycle will grow faster than the GDP, and Jamna will grow faster than the CV cycle as well. We get that. But can you grow by 15%?
It all depends on the demand, depends on, see, let's again talk long-term and macro. It looks like India's decade. Our company is very well positioned. We are a zero-debt company. We've had excellent performance in the past. You look at our market capitalization, you look at our return to shareholders, you look at our increase in market shares, you look how efficient we've been. So we are positioned. Now it all depends on how the economy grows, how the demand comes up. The government's doing an excellent job by spending on infrastructure. With e-commerce, the demand for trucks is going up. There is mining has started, road building is happening. So everything looks very hunky-dory and rosy. But to give exact predictions, all I can say it's going to be an excellent few years going forward, especially for our company.
Mr. Singh, we have more questions for you, but I'll come back to you. Nigel, finally tell us, what is the shareholding pattern for the company looking like, the focus on promoters, institutional holdings as well?
Okay, all right. Well, going through the shareholding pattern, the promoter entity is holding around 50% odd, while the FI holding is around 77% in the company. Out of that, small cap World Fund, that's a notable holder from the FI list. The DII list, well, it boasts of quite a few names: ICICI Prudential, L&T Mutual Fund, UTI Invesco, as well as Axis Mutual Fund. One more thing to notice, the institutional holding, well, it has been gradually increasing in the last few years, moving closer to around that 20% odd mark. Well, on the valuation front, there is no direct competition to Jamna Auto. But if you compare it with other CV auto ancillary stocks, well, it trades at a bit of a premium. So I thought Sonal just squeeze in the valuation part as well.
Absolutely. We always like more information on this one, right? So, Mr. Singh, as we were talking about promoter shareholding being at 50% levels as well, what's the intent of promoter group from here on as far as this is concerned?
Promoter, our intent is obviously we are backing this company 100%. And the reason is, whatever I told you in the last few sentences, how well we are positioned as a company. And we are run by excellent employees who are very loyal to us, who think like entrepreneurs, very hardworking, and there's a culture of constant cost reduction in this company. So we are very bullish, and if you'll see in the last, let's say 6 to 7 years, our holdings gone up by 6 to 7%. So, you know, I mean, we will keep, we really want to, we are backing this company. I don't know, to answer a question, what going forward our holding would be or will be increased, but we are fully behind this company.
Well, you'll have been creeping in over the last few years, and we note that. But before we let you go, the street would like to understand what is the succession plan from here on. Is the next generation interested in running the business? Could you clarify that?
My brother, the managing director, and I are firm believers that, you know, ownership and management should be separate. Succession plan all depends on a capable man to take over the helm of the company. It has to be a professional. It could be a family professional. It could be a professional, but no compromises on the running of the business. And ownership and management will never be together. At least, I mean, if it happens like it's happening currently, great. If it doesn't, the company will always choose the best successor.
All right, Mr. Singh, thank you so much for joining us today and explaining all about your business. So that was a deep dive into Jamna Auto. Nigel, thank you so much for explaining that as well.
Well, interesting piece. Play on the CV industry. If it's going to be the best year for CVs, let's see whether or not this one can do well from here on. For the time being, though, we'll slip into a short break. You come back. We'll focus on another interesting company, Chemplast Sanmar. That's the stock on our Swotlight segment. You don't want to miss this. Welcome back. You're tuned into Inside Out here on CNBC-TV18. Well, as promised, there's another stock on our radar. So I'll introduce the stock to us. Tell us, what are you focusing on in our Swotlight segment?
Okay, so Nigel, I'm going to be talking about Chemplast Sanmar. As I told you earlier, that this has been a stock which has been buzzing off late. In fact, it saw a lot of traction in the month of December. The stock, though, has not given much returns since the time of listing. In fact, it listed at a discount of 3% to its issue price, and the stock price is actually currently below its listing price of 550 rupees per share as well. So the underperformance continues. The company is a leading manufacturer of PVC paste resin and is also backward integrated for chlorine, ethylene dichloride, and vinyl chloride monomer, and this gives exposure to caustic soda, chloromethane and hydrogen peroxide markets as well. So yes, backward integrated is something which is a positive here.
Well, Sonal, so there are a lot of products that you spoke about. Give us a breakup. How much does each product contribute? And also, which industries are they catering to?
Okay, so there are 3 segments in a lot of products. So let me break it down for you. Each of them have number of products. So the first segment is specialty chemicals, which is 21% of the revenues. And this has 2 more segments. Specialty paste PVC resin, which caters to footwear. There's auto upholstery, there's leather and mats as well, with a capacity of 66,000 tons per annum. Then there is custom manufacturing, which caters to pharma, agrochemicals, API molecules, chemicals, and has a capacity of 1,068 tons per annum. Then there is other chemicals, where they manufacture caustic soda, which is catering to paper, textile, chemicals with a capacity of 1,19,000 tons per annum, hydrogen peroxide, which caters to paper, pulp, textiles, and has a capacity of 35,000 tons here. And lastly, third and the biggest segment, which is suspension PVC, which is used in infra, real estate, irrigation, and this is 66% of the revenues of the company. The biggest capacity here as well, more than 3 lakh tons per annum. Now, as per the company, it is the #1 manufacturer of specialty paste PVC resin in India, #4 of caustic soda in South India, #1 in terms of suspension PVC in South India, and second largest in India as well. It is also the #1 manufacturer of hydrogen peroxide in South India.
Okay, got that. How does all of this look at in terms of revenues as well as margins? And you said the stock has underperformed. Something to do with the financials?
Yes, it could be the reason why we have been seeing this underperformance, because revenues, they've continued to see an increase till FY22, and come FY23 the cycle saw a decline, and hence first half was not as motivating in terms of revenues. They came in at around 1139 crore rupees. So commoditized nature makes it volatile, and this can be seen in margins as well. After hovering between 17 to 20%, in first half it came at 16.8%, and this is a fall from margin levels of 23% earlier. PAT2 has been very volatile for the company. FY22 was strong, but first half not so much, and hence outlook will be keenly watched on this one.
Okay, all right. So you said that in December, the stock did see some buying. So what's working for the company, and what could the possible risk as well be for the company?
All right, so the company does have more capacity expansions in place, right? That could be a big trigger going forward, along with the focus on custom manufacturing. That is one thing that worked for them. PVC prices, they have been going up. The general idea is that PVC prices have now bottomed out and will only see higher levels from here. So that also bodes well for the company. Additionally, after a few years of pain in the balance sheet, company is now a net cash company. So there has been a decline from levels of 2100 crore rupees to now net cash levels. In terms of risks, the biggest one being commoditized nature, right? During COVID, there was a massive upside move in PVC prices, and then we saw massive decline as well. So that is something which keeps financials very volatile. So decline in PVC prices could be a risk, and if bigger players come up with more capacity, say Reliance Industries, then it could keep prices under more pressure, and that could be a risk.
Okay, let's round this up then, Sonal. You've given us a fair bit of understanding out there. Couple of things. One, promoter holding, and second, valuations.
All right, so the promoters, that is Sanmar Holdings, they have close to 55% stake in the company. As far as other investors are concerned, some big names. We have Mirae Asset Equity Savings Fund at 8.5%, Axis Mutual Fund Trustee Limited, that is around 3.5%, SBI Long Term Equity Fund, they have a substantial stake at 9.44%. There's Franklin, HDFC Life Insurance Company Limited at around 1.75%. There's Government Pension Global Fund as well at 1.37%. Now, while we have been talking about underperformance as well, that's the reason why the stock trades at reasonable levels at 10 times one-year forward earnings.
Okay, all right. So now, thanks a lot for that. That was an interesting one. Chemplast Sanmar, well, interesting, been a bit of an underperformer, but various triggers lie ahead. But we've completely run out of time on this episode of Inside Out. From Sonal and myself, it's goodbye.
But do write to us and tell us the companies you want us to discuss and you want to hear about. And we'll feature these on our show. Thanks a lot for watching us today.